It's time for a day's look at all the business news. Stephen Carroll is here with us this morning.
Hi,
Morning, Stephen. We're going to start off with news from the mining company Rio Tinto.
That's right. Profits of the world's second largest mining company fell by more than half last year to $4.5 billion. In net terms, the company saw losses of almost $900 million. That's down to the slump in commodity prices over the past year. Rio Tinto is to cut another $3 billion in planned investment. Its chairman has warned that the outlook remains uncertain for the coming year. Shares in Rio Tinto opened down nearly 3% in London. Rio Tinto's results come as the state of the mining industry is being discussed at a conference in South Africa. The mining in Bada, has been hearing from some of the biggest players in the sector, this against the background of low commodity prices. Well, our correspondent Aisha Ismail is in Cape Town for us this morning. Aisha, thanks for joining us. This is an industry under huge financial pressure. What's the mood like there?
Well, one of the biggest mining conferences in the world is drawing to an end in Cape Town, South Africa today. And one of the mining consultants I spoke to earlier described the mood and the atmosphere at this conference as somber yet sober. He said he used the word somber because of the state that the mining industry is in, not only in South Africa, but also in the world. We've seen major job losses. We've seen productivity being low, etc. The reason why he used the term sober is because he said although there are fewer delegates attending this conference this year compared to other years, the people that are attending the conference, that have attended the conference over the past couple of days, are the ones, as he put it, the ones that are serious about mining, the ones that are serious about projects. They've come with real projects, and they are the people who have come with lots and lots of money. So once again, just to stress those two words, somber yet sober.
This, of course, the atmosphere in the industry really is about falling profits. Many companies are cutting spending. Is there much talk there about job losses? Because, of course, this is a huge employer in South Africa.
Well, job losses did top the agenda here at this conference, and particularly because the mining industry is so heavily unionized in South Africa. We often see strikes in South Africa, workers saying that they work very hard, yes, yet they're earning very little money. And what consultants are saying, that the politicians are also feeding into this. They're not realizing that the mines aren't making enough money to pay the high wages that the South African workers want. The unions aren't helping either, because the unions are also fueling the flames by calling on their people and workers to go on strike. However, one of the mining consultants I spoke to did point out that it would appear that particularly in South Africa, the unions are coming to the table and realizing that they can no longer go on with the strikes and call for higher wages, because this will only result in more and more job losses. And South Africa, as we know already, has a very, very high unemployment rate. And already in the mining industry, we can expect more job losses this year and over the next 5 years.
Okay, Aisha Ismail reporting from the mining Indaba in Cape Town. Thank you for joining us.
Let's move on to market news now. Stephen, what's been happening?
We've seen European shares open down yet again today. The main European markets all down by over 1% at the start of trading. Societe Generale, the French bank, their shares are down over 5% after their results. They reported lower than expected profits. Investors, generally speaking, concerned about comments from the US Federal Reserve Chair Janet Yellen about the effects that the Chinese slowdown could have on the rest of the global economy. Over in Asia, we're looking at a different lineup of markets today than in previous days. That's because the Tokyo Nikkei is closed for trading today for a holiday, but we are seeing the Hang Seng Hong Kong back in business. That's down to 4% though, almost 4% at the end of trading. That's catching up, of course, on the big falls that we've seen on those markets. The Hang Seng and the Kospi have been closed for the first 3 days of this week. So they're catching up on those losses we'd seen a little bit earlier.
Let's turn to Twitter next. They haven't been impressed with the latest set of results, have they?
No, that's because it's failed to add any new users over the last 3 months of 2015. A growing users is a key measurement for a company like Twitter that has yet to report a profit. Company boss Jack Dorsey says they're working to fix what he called the broken windows in the service. William Hildebrandt reports.
It was big enough news to tweet about. For the first time ever, Twitter reported a drop in user growth. Excluding SMS-only users, the company had 305 million monthly users, down 2 million from the previous quarter. Wall Street has been fixated on user gains. Twitter's 300 million pales in comparison to Facebook's 1.5 billion and even Instagram's 400 million, a photo-sharing platform that was launched 4 years after Twitter. The company's earnings were broadcast on Twitter's video app, Periscope. CEO Jack Dorsey said management is making new changes to enhance users' experience, including rolling out a new timeline.
We think there's a lot of opportunity in our product to fix some broken windows and some confusing aspects of our service that we know are inhibiting growth. And timeline is a big focus area for that.
But will it be enough to soothe investors? The new timeline uses an algorithm to promote the best tweets rather than the most recent ones. And for better or worse, many users say that makes Twitter less unique and resemble more and more Facebook. Less than 3 years ago, the company went public with a valuation of $25 billion. Today, it stands at less than $10 billion.
Will Hildebrandt with that report. And that wraps up the business. Thanks very much for that, Stephen Carroll. More from Stephen throughout the morning, though.